Michael Burry saw the 2008 housing collapse coming years before the major banks. Now, he's issued a new warning. He predicts a financial collapse arriving in 2026 that will vaporize more wealth than the 1999 dot-com bubble. He is backing this up with his own money, buying massive put options to bet directly against today's soaring market. To understand why he's taking such a high conviction position, we have to look past the AI headlines and into the structural data he's actually tracking. Back in the mid-2000s, Wall Street laughed when Burry shorted the housing market. He walked away with hundreds of millions of dollars. Financial media often dismisses him as someone who constantly predicts doom. In reality, he's a value investor who strictly follows data to find structural cracks in the economy before they break. Those cracks are showing up in his latest filings. He is aggressively loading up on put options, which profit when stocks fall, targeting the most popular tech companies in the world, including NVIDIA and Palantir. People assume he is strictly betting against artificial intelligence hype. They are missing the larger dataset. Burry is targeting the structural foundation holding up the entire global economy. We are looking at three converging economic forces forming a perfect storm. The first element is the debt bubble. For 10 years, interest rates were near zero, flooding the system with practically free money. Think of a family buying a house on a variable rate mortgage at 2%. It looks affordable. Then rates jump to 7%, and the monthly payment doubles, triggering default. Multiply that by thousands of corporations. Companies borrowed heavily during the easy money years to fuel their growth. With borrowing costs now elevated, their margin of error has completely vanished. The second element is inflation and what economists call the lag effect. This diagram shows a three-part timeline of how central bank actions take 12 to 18 months to filter through the system. The aggressive rate hikes we saw throughout 2023 and 2024 will fully squeeze corporate profit margins by 2026. The second lag is the final drain of pandemic stimulus money that kept consumer spending artificially high. The third is the incoming corporate debt wall. Billions of dollars in corporate loans mature in 2026. Companies that survived on 3% interest will suddenly have to refinance at 8%. Historical data suggests the real pressure point arrives roughly 18 months after the initial rate hikes, placing the peak window for these maturing debts in 2026. This brings us to the third element, investor psychology. Financial media constantly promotes a soft landing, the idea that the economy will slow down without crashing. This creates intense fear of missing out, pulling retail investors back into risky assets at the very top. Imagine a 100-story tower. The public is celebrating because the penthouses are renting for record prices. Meanwhile, structural engineers are in the basement pointing at crumbling concrete pillars. When the foundation gives out, the penthouse falls with it. To know exactly when those pillars are breaking, Burry looks at specific data points. Here are the three signals you need to monitor. First, watch corporate bond yields. If the cost for companies to borrow money suddenly spikes, the market is pricing in bankruptcies. Second, track commercial real estate defaults. Empty office buildings act as the early warning system for the banking sector. The third signal is sentiment. When the market is in a state of extreme greed while the underlying structural data is collapsing, a sharp correction is imminent. A drop in stock prices is painful, but the ensuing credit freeze and bankruptcies will reallocate global wealth distribution in the years that follow. Seeing these numbers can cause anxiety, but the purpose of tracking this data is aggressive preparation, not panic. The investors who made the largest fortunes after the tech bubble and the housing collapse didn't perfectly time the bottom of the market. They simply avoided getting wiped out on the way down. Step 1 is to build cash reserves. When liquidity dries up and everyone else is forced to sell their assets at a loss, holding cash gives you the power to buy solid companies at deep discounts. Step 2 is reducing your personal leverage. If you carry variable rate debt, lock in a fixed rate immediately before the larger economic debt wall hits the consumer level. Step 3 is analyzing what you actually own. Reduce your concentration in overvalued tech and AI stocks. Blindly putting money into a falling index every month works during a bull run, but it drains your capital during a structural deleveraging. The strategy of buying growth at any cost worked smoothly for the last 10 years. It will likely struggle over the next 2. Adapting to this data-driven reality now is the most effective way to protect your position for 2026. Let me know your cash strategy in the comments below, and subscribe to the channel so you don't miss the next market signal.